Top 10 common mistakes in AI stock trading and how to avoid them. While trying our luck in the stock market, many of us are juggling the responsibilities of work that runs from 9 in the morning to 5 in the afternoon and family obligations. Trying to strike a balance between our day-to-day lives and our trading often requires us to learn via trial and error. It is well known that even minor mistakes in trading can occasionally have significant repercussions. In addition, given that trading is just as much about controlling one's emotions as it is about numbers, having a grasp of the typical errors that might occur in stock trading can make all of this much simpler. Let's get right into it. Number 10. Failing to conduct adequate market research. Imagine that you are on the verge of purchasing a new smartphone. You wouldn't go into it without first reading reviews or gathering information about its features with you. The same is true for business transactions. When it comes to trading, one of the most significant mistakes you can make is to ignore market research. There is a possibility that you could invest in the wrong assets if you do not conduct adequate research. Before you make a transaction, you need to do some research on the stock market and ensure you have a good understanding of its patterns. Number 9. Engaging in business on the spot. Have you ever tackled the task of preparing a new meal without first consulting the recipe? You could add ingredients at random or leave out some of them. To put it another way, you run the risk of being a disaster. That is exactly what happens when you trade without a plan. You may purchase and sell stocks without a strategy, relying on your gut sentiments or the advice of friends rather than conducting a serious examination. If you do not have it, you will have a greater chance of making typical mistakes in trading, which could have an impact on your profits. Number 8. An excessive reliance on software. How often do you follow Google Maps without question? Not likely at all. You may get stopped in traffic or accidentally take the wrong path. The same is true for business transactions. Trading software alone without having a solid grasp of the market might lead to decisions that are not in your best interest. Even though artificial intelligence trading software can provide useful data and insights, it is crucial to use it as a tool rather than as a substitute for your unique judgment. The utilization of software in conjunction with your knowledge and analysis will result in improved trading outcomes. Number 7. Not effectively reducing losses. Suppose you decide to purchase a pair of shoes only to discover that they do not fit properly. If you were to continue wearing them in the hope that they would get more comfortable, you would not do so. The same is true for business transactions. If a trade isn't going well, you shouldn't put it off for too long. Things cannot return to their normal state on their own. You must remember to steer clear of typical trading errors. When you want to prevent a little problem from developing into a more significant one, it is prudent to cut your losses early. Managing this situation and avoiding the worst possible trading mistakes can be made easier with the use of stop-loss orders. Number 6. Excessive exposure of a position. Are you someone who is just starting in the stock market trading world? If so, are you aware of the most common blunders that novice traders make in the stock market? An example of this would be putting all of your money into a single section or a single stock. It is a dangerous endeavor that may result in huge financial losses. Rather, you should be familiar with the concept of portfolio diversification. Consequently, you want to diversify your investments to disperse the risk that you are exposed to. Additionally, if one of your investments does not perform as expected, you will most likely still make a profit from the other assets. Number 5. Inadequately diversifying a portfolio in a short amount of time. Not diversifying your holdings can be a problem, but over-diversifying your portfolio is another typical trading mistake that you should try to avoid. Your portfolio may become confusing and difficult to manage if you diversify it too rapidly and to an excessive degree. When you add an excessive number of assets without conducting adequate research, it becomes difficult to efficiently track and manage your investments. If you want to get greater outcomes, you should always make sure to take the time to gradually grow and maintain your portfolio. Number 4. Not being able to understand leverage. Increasing your trading potential by borrowing money from your broker is what we mean when we talk about leverage. On the other hand, if things do not go according to expectations, it may result in large losses. One of the most significant trading blunders that should be avoided is a lack of understanding of leverage. Suppose you make use of leverage to purchase stocks with a value of Rs 10,000 using only Rs 1,000 of your own hard-earned money. If the value of the stock declines dramatically, you run the risk of losing more than the amount that you initially invested. Before you employ leverage, you need to make sure that you have a complete understanding of how it operates. Number 3. A failure to adequately understand the risk-reward ratio. Imagine placing a bet of a significant amount of money on a game in which the odds of winning are extremely low. Do you agree that it is a hazardous and not a sensible move? Similarly, the risk-reward ratio operates in the same manner in trading. It evaluates the potential gains in comparison to the potential losses that could occur. If you are putting a lot of money at risk for a reward that is only marginally conceivable, it might not be worth it. Before you engage in any kind of trading, you should always be sure that the potential gain is worth the risk. Your ability to make better decisions and prevent unnecessary losses as a result of trading blunders is improved as a result of this. Number 2, excessive exuberance following a profit. You might feel a lot of confidence after winning a few trades or making a good profit, but it is essential to remember not to let yourself get carried away by your success. When it comes to stock trading, it is simple to believe that you cannot make any mistakes. However, the most effective method to achieve success in the long run is to adhere to your plan and remain cautious. Number 1, allowing one's feelings to influence one's decision-making. Are you someone who has ever made a hasty purchase simply because you were experiencing a moment of impulse? When it comes to trading, emotions can lead to the biggest mistakes. When it comes to trading, it can be a very disastrous mistake to let your emotions direct your choices. If you want to be successful in trading, you need to adhere to your plan, manage your risks, and make an effort to avoid letting your emotions dictate your decisions. Final thoughts. In conclusion, trading is a journey that encompasses many different aspects and goes well beyond making decisions on the spur of the moment. Having a well-crafted plan, conducting extensive research, and having the discipline to stick to strategies even when market conditions are uncertain are all necessary components. Traders can construct a strong foundation for long-term success by avoiding common errors, such as ignoring risk management, over-leveraging, and allowing emotions to govern decision-making. Learning consistently is also very important. The financial markets are always changing, and a trader needs to remain up to date on the most recent trends, tools, and analytical approaches to succeed in the trading industry. Furthermore, to be successful in trading, patience and self-awareness are both essential components. Successful traders can be distinguished from those who struggle by their ability to recognize their own biases and to control their emotions, particularly when they are under pressure. Setbacks are something that even experienced traders endure, but the ability to learn from each error and adjust to changing conditions is a crucial factor that contributes greatly to overall performance over the long run. Understanding risk and being able to properly manage it is ultimately the most important factor in determining whether or not one will be successful in trading. Traders can boost their potential for success and create a more enjoyable trading experience by concentrating on continual improvement, improving decision-making skills, and maintaining discipline. Enjoy your trading. Don't forget to like, subscribe, and hit the bell icon for more updates. Drop a comment below. We'd love to hear from you.